Welcome back to smarthelping.com. I got a pretty simple model, a template here in Excel, but it's probably one of the widest use cases. Basically, anyone who's planning to buy a house could help with this. And what we're doing here is we're allowing the user to enter their income and expense assumptions and their purchase assumptions of the house, and then this runs a bunch of calculations to figure out how many months they have to wait until they have enough to buy the house, how much free cash flow they have currently, how much they'll have after their purchase, and then some charts and things. Um, so let's just start on income assumptions. And first off, this model automatically calculates the time. So you'll see this current, no matter what time of the year it is, it'll show the first day of the year, and it'll also show the first day of the current month. This is because you're obviously running this as of right now, assuming it's starting going forward. It goes over the course of 60 months, so we have a layover. So this way, we have 6 years here. If it's halfway through the year, you have to have a sixth year. Um, and it's just going to tell you based on your current situation and your planned amount of money you want to spend on a house and how much you want to keep saved, how much time, how many months you have to wait until you can make this purchase, and what your kind of free cash flow looks like. A lot of people, I don't think, try to track what their free cash flow is. It's a good thing to help with your discipline and spending, and you're trying to stay at that amount and figure out if you didn't, why, or what happened. Now, obviously, it won't be perfect, so let's just get in here. And I say it won't be perfect because of taxes. They don't happen every month. Like for me, as a sole proprietor, I pay every quarter, but you can kind of amortize it out to a monthly basis just to see, in general, how much cash you should be able to save each year after taxes. So let's say you make $6,000 a month in year one, and you could change your monthly amount you plan on making in year one, two, three, four, all the way to six if it changes. But let's just say I plan on making $6,000 a month. Let's say my total monthly taxes, state, federal, and city, are 1,100 a month. And then let's say my current living expenses. So this is actually, let's change this to living expenses. So this is going to be food, utility, rent or a mortgage, electricity, gas, anything that you're spending to survive every month. And so you should be able to estimate that number, whatever it is, and it could change over time as well. But this is the monthly amount in each of the years. So after that, you basically there shouldn't be anything else that's affecting your cash flow. So this should be your free cash flow. So it's your total amount you plan on making. And no, if you are a sole proprietor, as am I, you will take your net income here. So this is like, so say I have $50,000 in, or let's say it's $72,000 in annual income, but I actually have $10,000 in expenses for whatever else that's not counted in these expenses here. Then you would reduce that and recalculate your monthly amount based on the net amount you're making from your sole proprietor business. So that's what that should be. And then the taxes for, if you're sole proprietor, you got self-employment and income if you're just a regular W-2 worker. You've got, um, you know, federal, state, and local as well, but you don't have to pay an extra self-employment tax of 7.5%. The reason why these are hard coded is because taxes are so complicated and everybody's situation is different. So I just figured, you can figure out about what you think you're paying in taxes, per month, including, if you're getting a refund, then what's your total amount you pay every year less your refund, and put that into a monthly amount. That's what this is. Um, and if you are W-2, this would be your top line, like if you're a salaried, whatever your salary is before taxes and everything else here. That's what you need to populate. So you're taking out the taxes, you're taking out your living expenses. So this should be theoretically the amount of disposable income you have every month. And there shouldn't be anything else that dips into this unless it's unexpected or emergency. Now you may, to account for those things, you may want to put a reserve into here, built into it. So say if I really spend 1,100, but then I want to build in a $300 reserve, you can do that, and it will then reduce the free cash flow. So that's your general how you set this up. Then we've got your current monthly mortgage rent. or rent. Now, this number will be included in here, but I've broken it out as well. That's because we need to isolate this, and once you purchase the house, the model will show you your free cash flow after that purchase. And so we want to take out, your continue of living expenses, but we want to no longer have this because we're going to add in the new mortgage on a different row, so we just have to separate this out. So whatever you're paying, so this is a number that you would not be paying in the future after you bought your new house. Or, say you were renting an apartment, whatever the case, this number goes away, and then you, instead of paying here, you're going to pay on the new mortgage. All right, so now you've got your house assumption. So this is how much you plan on paying for the house, or how much you think the purchase price is gonna be, if you're doing a loan, the interest rate, term, or payments per year, term, percent down payment you want to do, and then here's your down payment. We've also put in here a cash reserve. So this is if you obviously don't want to just save enough money and then as soon as you get the exact amount of the down payment, you spend it all and you got no money in the bank. So here you can enter a reserve that will affect the time. You can see this is 14 months I have to wait at the moment. If I put this to 0, it goes down to 11 months, but then I have no money when that time comes. So you can customize this to fit your situation. Then this is going to be the monthly mortgage amount. So this is just doing a mortgage calculation based on the terms of the loan. This is your free cash flow at purchase. So, and actually, let's see, and then we have free cash flow per month after tax. And actually, this is going to be, let's see, is that right? 38. No. No, it needs to be, this has to, and see, this is where the circular reference comes in. Stand by 1 second. Okay, there we got it. So, man, circular reference errors are always a huge deal with mortgage stuff and loans and all this kind of thing. So we got it working now. So you can see um, the monthly mortgage amount is 1100. So your monthly free cash flow at the time of purchase. So let's say you make the purchase, you now no longer have any debt service at all. Your free cash flow is 4200. But well, now that you've made this purchase, you have to add in the new debt service. So remove that 1100, you're down to 3064. That makes perfect sense because this number should just be the difference of the 1100 current mortgage and the old $400 one, which was included in that living expenses. So you see that 736 should be the exact difference between your new free cash flow and your old, which it is 736. I'll tell you it's a lot easier to explain, but the logic for how to actually make that work right with this flowing model was not the easiest thing to do, but it's done now and it works, so that's good. Um, so we've got this chart here on the right. This kind of shows you running cash position. So let's assume you're starting with however much you want to say you got in the bank as of today. That's going to start growing at your free cash flow. So after everything you could think of that's going to come out of the bank, this is how much you got. At whatever point this reaches more than the down payment plus your reserve, you can see that is 60,000 right there, a little bit over the 50. It will assume you're going to make this purchase, put the down payment down, and then start paying the new mortgage. So now you're actually going to make a little bit less per month than you were making here. Unless your previous mortgage rent was higher than your new one, then you'll actually grow quicker. Um, and that's basically everything. The main tool is the use is that you can plug in all these assumptions and see how long you've got to wait. You can see what your expected cash flow will be given, these kind of things. Um, you can see what your free cash flow looks like before and after the purchase. You can change things over time, and maybe you want to show you that you're going to grow your income, and how does that impact how fast you can buy a house. Uh, there's just all kinds of uses, and I've made the assumption everything in light yellow you can adjust. Put a note on that. But it's just really dynamic, and I mean, pretty much anyone who's looking to save for a house will be benefited by using this as a kind of a planner. Just all cells in the shade. All right, well, that's all I got. If you want to actually get this template and use it, it will be a link to it will be in the description box below. I will charge a one-time fee of $45, and that's it. And once you after purchase, I'll send the template directly to your email. No worries. And this will be fully editable, unlocked, and you can use it, change the formulas, see all the formulas, however you want to play with it, plan out different scenarios. Uh, I guess that's about all I got for you. I'm going to try and enjoy the rest of my Saturday because it's a nice day out. Hopefully, this benefits some people. Have a great one. This is smarthelping.com.